how do you view this world where electronic trading has driven all manner of benchmarks and all manner of product expansion?
I think there's sort of two aspects to that. The one is that basically one of the things that electronic trading has done is it's made it much easier to list products. So essentially the marginal cost of listing an additional contract is close to zero. It's not like you're going to take up floor real estate. So it's easy for exchanges just to basically say, hey, we'll throw this out there. And if we build it, if people come, that's great. So what I think it's done is that, yeah, still, if you look at in the commodity space in particular, still WTI and Brent, despite what you note is their legacy and in somewhat sort of an anachronistic characteristics, still dominate in terms of volume. And that's just the sort of the old liquidity attracts liquidity story. And particularly for something like oil, where you have open interest maybe going out in decent amounts, 5, 6, 7 years, it's really hard to sort of move the market off of that. But the electronic trading has created the opportunity for a bunch of products that are complementary to and sort of specialized and allow market participants to sort of mitigate basis risk by trading in products that are more tailored to their specific needs. So that on the one hand, electronic trading really hasn't changed the fundamental tipping aspect and centripetal forces that tend to lead trading to concentrate in a relatively modest number of benchmarks, but it has allowed for the proliferation of products around those benchmarks. And so sort of a more diverse ecosystem. And that's the electronic trading has worked in both of those dimensions.
So that's very interesting. But of course, I mean, you mentioned, and it is a good point, despite the fact that we've got Murban crude, that we've had Spymex and St. Petersburg create Russian crude, which is obviously somewhat of a tricky issue to trade if you don't happen to be in Russia these days. But there are so many other benchmarks have opened up, which is fascinating. However, it hasn't all been plain sailing in West Texas Intermediate. What did you think about what I call the Cushing crisis when WTI prices suddenly went negative a couple of years ago?
So I think it's actually worthwhile to go back because in some respects there was a sort of a Cushing crisis in the 2012-2015 period where Cushing really became disconnected from the world market. And essentially what happened is that because of the shale boom in the United States, oil production became completely out of position relative to the infrastructure. So we had a big increase of production in the mid-continent of the United States, and the oil needed to go south, but all the infrastructure was oriented towards bringing the oil north. And so basically Cushing, which was on the north side of that bottleneck, became disconnected from global crude markets. And so this was a subject of a lot of criticism, but then market prices send signals, people responded to the signals, and then the infrastructure issue was essentially eliminated and Cushing became more connected with world markets again. Then you move forward, and so actually things, say 2015 through 2020, WTI, Cushing, the CME, CL contract were doing very well and everything looked fine. Then we get to April 20th, 2020. And so first of all, the underlying background conditions where you go in where because of the COVID crisis that had just begun, demand for oil cratered. Supply of oil is not as responsive. You just can't turn off a well like you can turn off your faucet. And so that meant, well, demand goes down, supply stays the same. We need to store more, even though after there had been sort of a storage crisis at Cushing in 2008, 2009, even though storage had expanded by a factor of about 2 after that, even that was overwhelmed by what happened. And so there was a concern that there wasn't going to be enough storage. And as the contract then moved into liquidation, so you had a sort of a very fraught situation where there was potential for bottlenecks to really impact the price of crude oil, in this case, a storage bottleneck. And then I think that was exacerbated by sort of, shall we say, strategic trading by certain market participants. And this was something that was covered relatively extensively in a Bloomberg article where some traders out of London bought a bunch of TAS and they sold a bunch of crude oil during the day in a situation where the market was going to be very sensitive to order flow. And I think you put those factors together and that result in the negative oil prices that prevailed on the 20th.